Hi, good morning, everyone. Welcome to our research morning briefing. Today, we have a few things on our agenda. We have first sponsors initiation, webinar highlights for Hyphens Pharma, Sasseur REIT, and CMT CCT, as well as updates on the bonds model portfolio, FOMC meeting, and SG Weekly. Without further ado, I'll start off with first sponsor. Okay, so just a brief background, FSG is a developer, owner, and financier of property projects. Property development historically makes up the bulk of its revenue. Its main operations are in China and Europe. We like first sponsor for three main reasons. Firstly, its property development segment, PD for short, has about 1 to 2 years worth of the group's revenue that has yet to be recognized. Gross development value for its existing projects are worth 5 to 6 years of sale. Secondly, FSG won the bid for a transit development project in Human, which will become one of FSG's largest development projects. Lastly, we favor the high recurring income coming from its property financing business, as it achieves a return of low to mid-teens, while the loan book continues to grow. In terms of key risks, we are expecting standard growth for the hotel portfolio. More will be elaborated later on. So just a note, sorry, Nat, can you move back to the previous slide? Yeah, so just a note, this report is actually produced under the SGX scheme. Okay, so introducing first sponsor. First sponsor is backed by two main stakeholders that owns a combined stake of 80% of its shareholdings. One is Hon Leong Group that most should be familiar with. It owns a 36% stake. Taita Estates is a private company that has a long-standing history, incorporated back in 1954. Just to give a bit more color as well, the Tai Tak family is one of the largest shareholders of UOB. The family was a co-founder of the bank with the Wee family and was the second largest shareholder until the merger of UOB and OUB. Tai Tak Estates does property investments and holds a 44% stake. Okay, giving you a segmental breakdown, on the top left chart, you can see that historically, PD makes up the bulk of the business, with the exception of this year, as most of the PD revenue for 2020 is yet to be recognized. From the bottom left chart, you can see that FSG has managed to grow its bottom line quite steadily at a 5-year CAGR of 19%. As mentioned, most of FSG's operations are located in China and Europe. FSG's net asset value grew at a 5-year CAGR of 10% from 2015 to 2019. Okay, first I'll start off with the PD segment. This is the list of projects that are currently ongoing. Majority of the projects are based in Chengdu and Dongguan. The total GDP for these projects are approximately 2.6 billion. Unrecognized revenue from developmental properties amounts to 586 million, which equates to 1 to 2 years of sale. This is because revenue is only recognized upon handover for the Chinese properties and by percentage of completion for the terrace tower. Hence, if you take a closer look, you can see that most of the properties in the list are due for handover either in late 2020 or 2021. There is approximately 2 billion worth of gross development value that is yet to be unlocked for the existing projects, and this is equivalent to 5 to 6 years of sale. The largest projects in the pipeline will be Plot E of Millennium Waterfront and the recently bidded Human TOD project. The Human TOD project will become one of FSG's largest development project to date. It's a mixed-use development bidded at 1.3 billion Sing in a joint venture with China Poly Group and the China State Railway Group. These partners are large state-owned enterprises which brings in multi-billion dollars in terms of revenue yearly. FSG owns a 17% interest in the JV. The land will be developed into a transit-oriented development with more than 1 million square meter in GFA, encompassing the different exchanges along Guangzhou, Hong Kong, Shenzhen, Humen, and Dongguan. Once developed, this site is expected to become a high-speed hub, which allows for travels to Shenzhen and Hong Kong within a span of 20 and 40 minutes respectively. This will probably make the property market in Dongguan hotter than it already is, which I'll elaborate more in the next slide. FSG saw overwhelming demand for the Dongguan property market. For those who are not familiar, Dongguan is a city in China's Greater Bay Area located between Shenzhen and Guangzhou. As Shenzhen remains a highly sought-after market due to its proximity to Hong Kong, Dongguan is benefiting from the spillover demand for the properties in the Greater Bay Area. Buying sentiments in the Dongguan property market previous slide, thank you. So buying sentiments in the Hong Kong property market have exceeded FSG's expectations after business activities resumed in late February. Since April, the Pinnacle project launched 5 residential blocks for sale, but it was almost fully sold soon after their respective launches. Another residential block was actually launched for pre-sale on 14 July and has since sold more than 85%. Okay, the second segment for discussion will be the property holding segment, which holds a portfolio of 18 hotels and 6 office properties in Europe and China. Most of the hotels and investment properties are based in the Netherlands. Arena Towers, its largest investment property by percentage stake, continues to provide steady recurring income at yields of more than 6%. The 2 hotels in Amsterdam are master lease agreements with rent escalations linked to the CPI with a tenure of 25 years. Additionally, amidst COVID-19, the tenant is still rent paying. FSG holds a 3 months banker's guarantee for that lease. With regards to the other investment properties, most are rent paying except for a few small tenants. FSG has also hinted that there are opportunities for acquisition, with cash levels at 475 million and low net debt to equity ratio at less than 0.2 times. FSG's balance sheet remains robust. Additionally, FSG holds 520 million of undrawn debt facilities and outstanding warrants of approximately 400 million to allow FSG to take advantage of opportunities for acquisition whenever they arise. The last segment will be property financing. FSG will still be growing the most lucrative business segment. If you look at the chart on the left, property financing has the highest gross profit margin amongst all its business lines. The loan book is still growing at double digits year on year. Its China loan book grew at a CAGR of 19% from 2015 to 2019, largely attributable to the high demand for credit among the SMEs. Average tenure for the China loan book is 3 years. In light of the current economic climate, FSG has received overwhelming requests for loans. However, FSG will cherry pick and be more selective of the loans to take on. We are estimating a loan book growth of about 8% for FY20 and 21. Okay. Additionally, FSG has been operational for 8 years. To date, FSG has not incurred any bad debt loss from its PF operations. In 2015 and 2016, FSG did experience 2 cases of default, but both were well handled. Both principals and interest have been fully collected, and a 30.4% return per annum was actually registered for one of the defaulted loans. Average loan to value range for the PF portfolio remains conservative at a low 40 to 60%. Next, please. Lastly, FSG is growing its PF business segment through its maiden PD venture into Australia to redevelop City Tattersalls Club. In Australia, there is a need for portfolio financing because buyers only pay 10% upfront, and the remaining will only be paid upon handover. So in this case, FSG will be a financier and an equity partner in this project, as they'll be charging a single-digit interest rate on an Aussie 370 million loan to fund the project. This is while holding a 40% equity stake. The construction for this project is expected to start in 2022. Okay, in terms of key risks, one of the risks that we identified will be with the hotel portfolio. FSG's hotels are located in parts of Europe where hotels saw a greater recovery in August, boosted by the demand for staycations. However, Netherlands has seen a resurgence of COVID-19 cases, as new cases in September exceeded its peak in April. We are expecting a stunted recovery for the hotel portfolio till the end of 2020. Additionally, next slide, please. Additionally, the reassessment of development pipeline is expected to slow growth plans for FSG. FSG was planning to redevelop an office property in Amsterdam and a Bear hotel in Milan, but those plans were shelved in light of market conditions. On the PF front, short-term deferrals were provided for 40% of the China loan book. However, those loans were secured on a conservative LTV ratio of 44 to 55%, and on sizable collateral such as the Guangzhou City Hotel, a residential villa, and a retail mall. Additionally, there were also conditions to be fulfilled for the larger loan to defer its interest payments. For the 580 million loan, the borrower can defer 50% of the interest payments for a few months, only if it contributes additional equity to their joint account. The other smaller 330 million loan only deferred their interest payment for a month. To conclude, we are initiating coverage on FSG with a buy and an RNAV derived target price of $1.65, implying a total return of 33.6% and a dividend yield of 1.75%. Our target price is based on a 30% discount to its fully diluted RNAV per share. Based on the current number of shares, we derive a target price of $1.99. At current prices, FSG trades at 0.6 times price to book value versus its historical 5-year average of 0.7 times. I'll pass my time on to Wee Kwang, who will tell you more about Hyphens Pharma.
Morning, everyone. I'll now be talking about Hyphens Pharma. Presentation highlights from last Thursday. So they had a webinar with us, and most of it is just to explain how the business has been and how the business will be moving forward. Okay, so generally during the webinar, the CEO highlighted two main news that came out over the past quarter that will probably impact how the company will grow moving forward. The first one is an active expansion of the product portfolio as they acquired the hair growth product brand CG210. This is added to its proprietary brands portfolio. So this has a significance to what kind of margins it's going to earn, and I'll explain on it later. And this CG210 will be added to its existing portfolio of Ceradan and TDF as well as Ocean Health. So the second news was actually their partnership with Hong Kong with lifestyle brand SUTL to enter the Hong Kong market for its Ocean Health brand. So this will be their first move into Hong Kong, especially for this Ocean Health brand itself. Yeah, next. So I think the main question that most investors will have when it comes to these two news is that how does it actually complement their current business strategy? Next. So just to take note, they actually operate three business segments, and these business segments is actually operating on very different business models, okay, and across different geographies as well. So you can see that although currently they have direct footprint in Singapore, Vietnam, Malaysia, Indonesia, and Philippines, their partnership with SUTL is actually kind of like indirect into the market. And for now, okay, so on screen you can see is actually the kind of like an industry value chain for these pharmaceutical and medical goods. And each product itself represents a separate value chain. And for their acquisition of CG210, they actually acquired full ownership of the brand itself, including your trademarks and everything, to sell and into the markets for Singapore and Malaysia. And it is actually added to their proprietary brands portfolio, which means that they act as the brand principals within this entire industry value chain. And then they will be distributed through Singapore and Malaysia. In terms for their SUTL partnership, we can see that for Ocean Health, it is already their brand principal because it's under their proprietary brands segment. And then when they partnered with SUTL acts as their distributor in Hong Kong. So in a sense, for SUTL, they have multiple ways to enter the market. They can actually go through wholesalers, or they can actually sell directly to the market. And considering their presence in Hong Kong, they can actually do that pretty well into the retail market directly. Next. Okay, so for what we see is that these two news that they came out with actually enhances their presence in the entire value chain as a company. Next. So we see that, next. Okay, so we see that for Hyphens Pharma, who operates their three business segments across proprietary brands, specialty pharma, and medical pharma, they're actually quite kind of well integrated within the entire value chain. So for proprietary brands and specialty pharma, proprietary brands, they act as the brand principal and they own entirely where they can sell. And now CG210 is actually added to their portfolio. It actually enhances their margins as well. And for specialty pharma, they actually take the products from like Sterimar, Vivomix into their own hand and sell it within the specific markets. And then their medical hypermart, which is pan-Malayan, actually is to sell in Singapore only. But if they want to, when they are entering other markets, right, they actually go through other intermediaries to act as the wholesaler for that particular market. And although the medical hypermart is although the hypermart is a more low margins business, but then they are compensated with a higher volume and turnover. And for their partnership with SUTL itself, you can see that actually the SUTL will fall under this red color box, the other intermediaries. So they will be responsible for selling into Macau, Hong Kong, and the China duty-free shops. So back to the question of how does it complement Hyphens Pharma current business strategy? Okay, so generally what we see the moves made by Hyphens Pharma is that they are kind of quite actively expanding their presence across the entire industry value chain by expanding their portfolio and enhancing their market penetration for their existing brands as well. So this shows that they are actually doing a lot and moving, although they are currently, because the entire industry is pretty fragmented, there is a lot of room to grow next. So we can see that they are trying to grow both organically and inorganically with all their acquisitions and partnerships with other people. And there is a lot of room to grow, especially considering that at their current stage, they are still a pretty small player within the entire market. And that's it from me. I'll now pass the time to Nat.
Hi, okay, so today I'll be talking about the presentation highlights for Sasseur, as well as for CapitaLand Mall Trust and CapitaLand Commercial Trust. So first on Sasseur, just a little bit of company background. So Sasseur was listed about 2.5 years ago on the SGX. Their portfolio consists of 4 outlet malls in second-tier cities in the People's Republic of China. So these cities are Chongqing, Bishan, Hefei, and Kunming. The sponsor has given Sasseur 2 ROFR assets. So ROFR stands for right of first refusal assets. And their sponsor also has 9 other assets that will become Sasseur's pipeline. So gearing is relatively low at 28.1%, and Q2 occupancy was at 93.6%. So this is slightly down from 1Q's 94.8%. WALE for Sasseur is relatively low at 0.8 years. This means that for 2020, there was 62.4% of leases who were expiring. So on a year-on-year, on a one-half basis, year-on-year, sales was down by about 39%. Okay, so this is the tenant sales for the first half as well as the second half. So first half, you can see that tenant sales was actually down by about 56%. In Q2, tenant sales recovered strongly by 56%, but however, it was still down year-on-year by about 18.6%. So overall, the 1H performance was down by about 39%. So Sasseur has a relatively unique revenue model. So they actually the revenue is actually derived from this entrusted manager agreement. So it's the EMA for short, where this EMA rent consists of a fixed portion denoted FC, as well as a variable component denoted VC. So this FC component will grow at about 3% per annum, and correspondingly, the VC portion will actually decline. It's actually capped at about 611 million renminbi. So, so 3 points that the 3 takeaways from the presentation. First of all, there was a lot of commentary on the WALE by GRI, which is actually relatively low at about 0.8 years. However, due to the demand-supply gap, outlet malls are considered a high-growth retail segment. So this actually helps. Having a short WALE actually allows the entrusted manager to increase the commissions upon renewal. And it also allows the entrusted manager to replace poor performing tenants. The second point is that Sasseur positions themselves as a double destination kind of shopping venue. First of all, they draw customers, sorry, it's a typo here, from their value, due to their value for money proposition, where tenants must actually provide 50% discounts on the real retail price. So this is actually written into their tenant agreements that they must provide such an attractive discount for their shoppers. And of course, they also position themselves as an experiential shopping destination. The third point, of course, is that the outlet mall shopping venue is actually generally not as impacted by e-commerce. So this is because, first of all, the different product mix, online transaction, or rather transactions made from online platforms are usually around the $200 renminbi price tag. However, the kind of transactions that that are happening at the outlet malls are around the $800 to $1,000 renminbi kind of price tag. So this is a different kind of product, and also therefore there's minimum product overlap. Second, of course, is the lower commissions charged at outlet malls. So Sasseur charges 10 to 16% commissions on sales. However, this is a lot lower or cheaper compared to the 20% commissions that are charged via online sales channels. There's also guaranteed authenticity, meaning that the merchants are actually subject to a 10 times penalty if customers report a fake sale. So this actually prevents or deters the merchants from selling fake goods, and therefore guarantees authenticity. So moving on to CapitaLand Commercial Trust and CapitaLand Mall Trust proposed merger presentation highlights. So they did a presentation for our TRs, and here are the highlights. So they just focusing on the benefits of the proposed merger. First of all, is the leadership, best-in-class portfolio supported by a stronger and more efficient platform. So as CMT and CCT, they both have very long histories on the SGX, and they both have brought to the table a lot of value unlocked for their shareholders. In terms of resilience, the enhanced portfolio will actually help to diversify the revenue from the assets as well as from tenants. So this helps to enhance resilience. Third of all, there will be growth opportunities. I'll elaborate more on this later, and as well as the DPU accretion for the CMT and CCT unit holders. So on leadership, the proposed merger will actually see the combined REIT, which will be called CICT, leapfrog to the second largest REIT in the Asia Pacific region. So this increased visibility will provide potential higher trading liquidity as well as a positive re-rating and more competitive cost of capital for the REIT. There will also be potential synergies, such as synergies unlocked from cross-selling due to the broader leasing network, and cross-selling between the retail tenants as well as the commercial office tenants. The enhanced digital platform and data analytics. So this will help the tenants. This will allow the integration of CapitalStar at Work, which actually was on the CCT platform, as well as the CapitalStar program, which was on the CMT platform. So the integration will actually help to benefit both the tenants as well as the customers. Cost optimization from economies of scale through bulk procurement, supply chain optimization, as well as the elimination of frictional costs. This will help to unlock some cost savings for the REIT. Moving on to resilience. The enlarged REIT will have greater stability through market cycles. Actually, this is seen by a very well-balanced retail, office, and as well as a integrated development portfolio. So roughly they're about 30% each, 30 to 33% each distribution within these three asset classes. So this provides for a very stable and diversified portfolio, and it will help them invest through the market cycles as well as greater stability and reduce asset concentration risk. The last point of all is the increased flexibility to undertake portfolio rejuvenation as well as development. As you can see from the graphs below, an illustrative example would be for $1 billion redevelopment on a $1 billion asset. If CMT were to undertake this redevelopment on their own books, the impact to MPI will be about 7%. However, the impact to the merged entity will only be 4%. Similarly, if CCT were to undertake the upgrading of 21 Collyer Quay on their own, the impact to MPI is about 5%. However, for the merged entity, the impact is only 2%. Third, on growth. So because CICT, CapitaLand Integrated Commercial Trust, their mandate will be trending towards more of mixed-use kind of integrated developments. And so this actually plays in nicely to the URA master plan, where the master plan itself is also trending towards mixed-use precinct and integrated development due to the land scarcity in Singapore. So this allows CICT to actually capitalize on such trends, or trends towards mixed-use precincts. And of course, not to mention, we all know that CapitaLand Mall Trust and CapitaLand Commercial Trust both have domain expertise and track records of repositioning their portfolios. Some examples are for Funan and Capital Spring. The assets are also strategically located in identified growth clusters in Singapore. We can see here in the graph, some of the assets are located within the Jurong Lake District, as well as the Woodlands Regional Centre, the central area, which comprises Orchard Road and the Central Business District, as well as the Bishan Sub-Regional Centre. Last point would be on accretion. So this, on a pro forma basis, based on the last 12 months earnings, you can see that the accretion to CMT unit holders is about 4.1%, and the accretion for CCT unit holders about 7.6%. So all in, this is a recap on the previous, on the deal metrics. So for what's happening here is that CMT will be purchasing or acquiring all the shares of CCT. So for one CCT share, the unit holder will get 0.72 CMT shares, as well as a cash component of 25.9 cents. So this 25.9 cents will actually be financed via debt. And for avoidance of doubt, the CMT unit holder who has one share pre-combination will also have one share post-combination. The EGM will be taking place on the 29th of September with the long stop date and the cleanup dividends paid out by the 30th of November 2020. So that's all for me. I'll pass the time on to Timothy.
Thanks, Nat. So just a short update about our Phillip model bond portfolio. So we just launched this last month. So our model bond portfolio outperformed the benchmark index, which is the TRIH Singapore Fixed Income Index that tracks the total return for the Singapore corporate bond market. So our portfolio actually outperformed by 0.05% for the month and also showed lower volatility. So here is the list of bonds that's in the bond portfolio. It's a list of 10 wholesale bonds diversified across various industries, including healthcare, real estate management, logistics, e-commerce, REITs, and banks. There's a mix of a total of 5 bullet bonds and 5 perpetual bonds. These bonds are spread across a total of 9 companies, including Thomson Medical, RIXM Management, ESR Cayman, Olam, Fraser's Property, Mapletree Logistics, SPH REIT, UBS, and AIMS APAC REIT. So the portfolio for the month performed at 0.71% compared to the benchmark index of 0.65%. Given the risk of bear steepening, which is we see that long-term interest rates have a potential to increase faster than short-term interest rates in the future due to the Federal Reserve's expectations for higher inflation. We take comfort that this portfolio has bonds which have a relatively shorter tenor, so between 2 to 6 years maturity or call dates. This is to help to mitigate and offset the risk of higher interest rates in the longer term. The portfolio also has, the bond issuers for this portfolio has a range of strong backers and stakeholders that will help to secure funding and help operations should the need arise. So examples of these strong backers include Temasek, Warburg Pincus, and TCC Group, which is the 3rd largest conglomerate in Thailand. So we focus on those issuers that have established stakeholders, and this acts as an extra safety net during the pandemic. So overall, we are still maintaining the holdings for the bond portfolio this month. Okay, just an update for Asia bond valuations. So bond valuations in Asia, we still see valuations at attractive levels. So for the investment grade bonds, which is on the left side, you can see that it's still trading above the average, which is the green line. And for high yield bonds, which is on the right side, we can see that valuations are still trading significantly above the historical average, which is the green line also. So valuations are still attractive in Asia. And when we compare the yields in Asia to the US, it's still at a historically attractive, relatively speaking, with regards to the valuations. So we still expect demand to continue into Asian bonds, which you can see that the recovery is still there is still an ongoing sharp recovery in corporate bonds in Asia. All right, that's all for me.
Okay, thanks, Timothy. So now I'll be touching on the FOMC meeting highlights, which actually took place last Wednesday. Next slide, please. Okay, of course, the key takeaway that we see will be that in line with the Fed's lower for longer stance, okay, the dot plot release actually showed that interest rates are expected to remain low until at least 2023. Okay, so as you can see, this is an extension of a timeline from previous meeting by an additional year, okay, which seems to further reassure markets of Fed's dovish stance. Okay, in terms of economic recovery, things are actually progressing faster than expected. Okay, with better figures expected for Q4 2020. Okay, for real GDP growth, there is an upward revision from June's projection. Okay, whereas for unemployment, there is a downward revision. So the strong recovery in the labor market could have already been expected by the market. Okay, considering that we have actually seen a better than expected fall in unemployment figure in August. However, despite the strong recovery, okay, we have a comment by Powell who indicated that the path ahead remains highly uncertain, okay, which seems to question the fact on whether the strong pace of economic recovery can actually be sustained. Okay, in terms of Fed's new stance on the average inflation targeting, okay, the meeting actually did not provide any further specific as to how long or how much inflation will hold above 2% before any rate increase will be considered. Okay, but based on the economic projections that is provided by the Fed, recovery in the labor market will actually drag through until end 2023 before it reaches a pre-COVID level. Okay, so I think we can safely be assured that any rate increase may only be considered after that in 2024. Okay, lastly, in terms of additional remarks from the press conference, okay, Fed also reassured market that they do have plenty of tools in their arsenal to support the economy. Okay, some examples will be in terms of yield curve control, forward guidance, and more asset purchases. Okay, however, it's pointed out that more fiscal support is likely needed. Okay, which reminded the market of the stalemate that we see. Okay, for the recent fiscal relief plan from Congress. So despite trying to have a compromise between both sides and even coming up with a smaller scale skinny deal, okay, things have not actually come to an agreement. So currently, I would say the need for this fiscal support will remain the key risk for the economy right now. Okay, so that's all from me. Now I will pass the time over to Paul.
Okay, thanks, Chun Long. Our next slide. Okay, in terms of, as usual, we'll just go through some of the key macro highlights for Singapore. We had our export numbers, which actually was surprisingly still good in August. And actually year to date, in 2020, actually our exports are higher than 2019. So actually it's performing better than last year in a sense. So generally resilient. We also had the final numbers for our employment. I think the two key message here for our employment is that I think the losses that we got, the 138,000, almost half comes from F&B, retail, hotels, and the other rest, another 14% came from construction. That's point number one. Point number two, later you see that 138,000 also means that we lost two years of job gains. So it's quite it's obviously a very severe impact to the number of jobs in our economy. The other data point we got was SIA numbers. It's still very bleak. The numbers they only carried about 30,000 passengers in August. Just to give you a comparison, a year ago it was 1.91 million. So you can do the computation as like down 99.9, some ridiculous amount of number. And the month-on-month improvement in SIA also didn't really change much. Last month was 28,000, this month was 30,000. So month-on-month also no change. In terms of taxi, we got some numbers on the fleet. The fleet surprisingly actually also increased very modestly, I think 100 plus number, but I guess that's still a positive. In terms of, there was of course the usual data dump in China. Lots of data coming out in China, but we just try to pick one or two key ones. So for us was the loans growth actually still 13%, which is a huge number. I think that it shows that the economy is still leveraging up and the economy in China is still vibrant. Just to give you some context, loans growth in Singapore is like minus 0.5. So if Singapore ever got 13% loans growth, I think we'll have a good time here. But anyway, in terms of the residential, just to follow up on Chair Hui's report, residential space sold in China was actually up 15%. So it means that year on year, the number of properties sold is up 15%, and it's probably the fastest growth in 3 years. Just not much on the US, just the retail, so it's pretty healthy. And just to follow up on Chun Long's US Fed comments, I guess the two checklists, just to summarize, the two checklists before we raise rates is that you need maximum unemployment. Basically, unemployment rate needs to go to 4%, which is almost full employment. And then and you need inflation to be above 2 and for some time, which nobody actually knows what some time means, but because they never really specify. But what it also says that the last time when unemployment rate actually dropped, the Fed started to raise rates. So this time around, even if unemployment drops to 4%, which is not technically kind of like full employment, it means that the Fed won't move until you see both conditions happening. We'll later just brief you on the straits trading webinar that we have. There's some key highlights. In our tactical views, we are cautious. I think there are some impediments to the market. I think firstly, you got the US fiscal cliff. There's still uncertainty whether the stimulus will happen. Then we will show you a chart later. Then the COVID-19 is starting to, there's a resurgence in COVID-19 cases globally. I think globally we hit a new high again. And of course, with the upcoming elections, just less than 2 months, I think less than 50 days away, there is some uncertainty as the race gets closer. And the bigger worry is that if the election result is contested, that will probably hurt the US market, because then because a lot of it is postal votes, then there'll be a lot of issues like who is the final winner of the elections. In terms of quick update on the US stimulus bill, obviously it's important for the market. It's still a bit of an impasse between the two parties. The timeline is a bit tight because the House actually breaks on 2nd October and the Senate the 9th. Of course, they can extend it, but the timeline is a bit tight for them to get a deal done. Anyway, in terms of the weeks ahead, you probably see a lot of news. Will be a lot of Powell testimony. I think he's got like 2 or 3 days of testimony. But I mean, I don't think he can say much. The rates are already so low at almost 0% interest rate. What else can you stimulate? Then, in terms of our events for Singapore, our POEMS events, for this week we have a ComfortDelGro. So ComfortDelGro will present our webinar tomorrow at 2 p.m. And the following week we have AIMS and of course First Ship Trust. First Ship probably has not done any presentation for, I don't know, maybe years. So it'll be interesting to hear from them. And of course, 3rd October on Saturday, we will have our PSR, our Singapore strategy in the morning. So do look out for them, and you can just go to the link. Not every event might be in the link, but some might be a bit more delayed. Yeah. Just very quickly on the straits trading event. I mean, just very quickly, you know what the company does. If you refer on the chart on the right, so bulk of the assets for the company, that 74% that you see, is actually in real estate. But sometimes can be confusing is that in that real estate there are many parts to straits trading real estate. So there's direct investments, as you can see, 24%. So that is, they invest in Australian office, I think 2 Australian offices and Chinese malls. Then another part of their assets is invested in private equity funds that invest in property. Then of course the more notable, more popular one is they have a 22% stake in ARA asset, which is account for 14%. Then the rest, and the other curious thing is, of course, they have a 54% or 50.8% stake in Malaysia's Smelting Corp, which is a tin operations. So that kind of might sometimes put investors a bit off because they have this tin, but and they of course have some hospitality. But anyway, just to give you the bottom line is the stock is cheap. If you look at the NAV per share at the bottom, that 3.56. So that is the book value, virtually the book value of the company. Then compared to the current share price, 152. So this stock is trading at almost 60% discount. And then if you add in the ARA, because they recently increased the stake in ARA, so if you kind of work backwards, that implies an additional 200 million in value. So what it means is that the revised NAV for Straits is $4. So again, it's still at a 60% plus discount. So one thing about it, and at this price, it pays about 4% yield. So the major catalyst, I guess, is not if there's any listing in ARA, then probably there will be a lot of interest in this stock because it's about just monetizing the assets, but it is cheap in terms of the book value. Next slide. Anyway, just as usual, we just have a quick look at what is happening on the COVID numbers. Globally, you can see the blue line is actually hitting a new record of almost 284. one of the reasons, of course, you can see in Europe, COVID cases actually hitting almost 50,000 a week. So all this only raises the risk of more lockdowns globally, and it's not good for global growth. Nothing much. The one on the right is just to show you what is happening in France. Again, I'm not sure why they didn't really clamp down. It's hitting new high, almost 8,000. Right now, the numbers are hitting even 10,000. Next, okay. Anyway, for Singapore, in terms of cases in total, not just community but total cases, we, as you all may all know, we are the daily lowest since March. So that's very good before the whole pandemic kind of started. And our community cases is one. So all this means is that we can expect more easing of lockdowns in Singapore, which is a positive for us. Next slide. Nothing much, just to show you the export numbers. No, actually the exports in 2019 was down for Singapore, but this year it's up. You can see the 5.9%. So we will probably hurt more by the trade war than hurt by the pandemic. One way to kind of read it. And of course, it's good that the electronics industry is up about 4% compared to the decline last year. Okay, and this is just a quick look at the employment. So the table on the left shows that we lost 113,000 jobs in the second quarter. First quarter is 25,000. So you add these two up, what it means is that the last 2 years of jobs that we secured, we just lost it in 6 months. So obviously it's not a good number to have. And the table on the right is just to show you most of the losses is in F&B, retail, wholesale, accommodation. The reason why we did this is just to show you that the blue part, the blue part, finance, insurance, these are mainly the office tenants. So what it does, unlike in the global financial crisis, this time round, it didn't really hit the finance industry, the accounting, which are, these are the major tenants for some of the REITs. Like if you see someone like, I think CCT, I think almost 40% of their tenants come from finance and insurance. So they kind of placates them. So don't have to worry. I mean, it's obviously not good, but don't have to, it doesn't impact them as severe as what you see in the F&B, retail, and so on. Next slide. Again, this is part of a very bleak chart. This is just to show you the collapse in passenger carried. And that's why the worry for us is even if it recovers, even in 6 months' time when it recovers, it could be only 400,000, 500,000, still far away from what we had pre-COVID. This is probably like 3 to 4 years before we actually hit that. Nothing. Okay, this is a very complicated chart, so excuse me for that. But anyway, the left one is just to show you the number of taxis. So if you look at the table, December, so this year we lost about 12% in taxis, private cars about 6%. And then we just got a modest increase, 178. So it's beginning to stabilize at least for the taxis. And the table on the right, you can see the highest taxi relief. So just to show you what some of the reasons why we still have a buy on Comfort is that, as you can see on the second quarter, the 70.3 million, this was the amount of relief they gave. So as you know, every taxi driver pays Comfort daily, maybe about $100, just roughly. So they kind of just waive everything. And then, as you can see, the relief start to taper down. Second quarter is still 28 million, but it's starting to come down. So for us, we still like Comfort mainly because the sector is still challenging, but I think it's recovering. And what you're getting is a 60% market share in taxi, so that crept up for Comfort. And also the competitive dynamics is modestly improving. As you can see, the taxi fleet is up, and private cars is also facing a similar decline. Yeah, and for us, it's just a play on the relaxation of the lockdowns as lockdown eases in Singapore. Next slide. And then nothing much. This is just a quick look at the US numbers. Retail sales surprisingly is actually up. I mean, not surprised. There's a V-shaped recovery in retail sales. And the one on the left is just to show you the unemployment situation in the US is still quite bad. As you can see, right now, the number of people taking unemployed insurance is about 12.6 million. I mean, basically, these are the people that's unemployed in a summarized manner. This is even worse than the global financial crisis, which is 5.6. But of course, the other way to look at it is that the peak was 22.3, but it recovered very fast. The US, 11 million jobs were added in just like 1-2 months. And just to show you what's happening in China, just to have a quick snapshot. In China, you can see that loans growth is 13%, so it's very robust, and it's like record amount of loans being dispersed in the economy. So that is of course good for all the fixed asset investments and property. The chart on the right is just to show you the whole of China the amount of space sold is actually up 15%. It's the fastest in, I mean, it's about 8 plus, but the most recent number, because this is the 3-month moving average. So it's still the fastest in 3 years. And it seems to be accelerating even more. Okay, anyway, there were some people who asked about the IPO calendar. So we just give you a snapshot. What is the IPO calendar? Again, most of these companies we don't even know, but this is just to show you the number of listings. I guess the only conclusion, but as you know, we are focused on Singapore. So the only conclusion I can say from this is that at least for listings in Singapore market is like a graveyard. So there is no listings. It's more like a lot of delistings in the on the SGX market. So most of the listings you can see is Hong Kong and US. This just for next week. And this is just for your reference. Of course, someone did ask. So yeah. Okay. Anyway, I think this will be the last slide, and we can take Q&A. Thank you, everyone. I think Natalie, we got some questions for you. Then we got Hyphens, and we got technical, but for Wayland.
Okay, hi. I guess I'll go first then. Okay, so we have some questions on CMT and CCT. So I'll read out some of the questions. They are, when should we enter CMT and CCT, before or after merger? If before, which one is a better buy? Other similar questions, is it better to buy CMT or CCT now? So I think we went through this over the previous webinars. So actually currently CMT and CCT, they are more or less trading in tandem based on the exchange ratio, which is the 0.72 exchange CMT to CCT to CMT exchange, as well as the 285.9 cents. So it is trading in tandem based on this ratio. As of which one to buy, initially we had talks about how if you're of the view that the merger will go through, then you should buy CMT, because currently CMT, because it is in the retail space, they are actually offering a higher dividend compared to CCT. Of course, this is because of the risk related to the retail segment, or rather the retail sector, because retail REITs generally they command a higher yield due to the cyclical risks. So that's it. If you were to hold on to CMT shares, you will definitely get a higher cleanup dividends. However, that entails you to assume the risk for the retail sector. So actually, relatively indifferent between CMT and CCT, which one to buy. But of course, I think if you were to buy CMT, first of all, you get higher dividends. Second of all, you are less concerned with the, because part of the purchase consideration, CCT unit holders will actually get a cash component. So meaning to say that they are sort of cashing out on their investment. So there will also be risk of odd lots. Yeah, and then if you would like to reinvest in CICT, then you incur additional costs. So it looks like CMT would be the better buy. Of course, if you're of the view that CCT, the merger will not happen, then you will most likely tend towards holding CCT. Yeah, and that's because currently CCT is as a pure play office REIT. If the merger does not happen, there might be a potential re-rating from being unpegged from the CMT share price. There's another question here about after CCT and CMT's merger, will dividends be affected? Yeah, we think that the dividends will be affected, and positively for that in that regard. So because the merger is supposed to be accretive, so CMT and CCT unit holders should expect a growth in their dividends. Yeah. Okay. So we haven't actually computed the actual accretion yet, but pro forma, as mentioned earlier, it will be about 4% for CMT unit holders and about 7% for CCT unit holders on a pro forma basis.
Hi, yeah, I will take the questions on iREIT. So I have two questions here. One is whether or not my TP still hold, and any updates since the report. The second question is whether is on my view on the iREIT's offer, and should you pick it up. So I'll answer these two questions together. Yes, I do. Yes, the target price still holds, and yes, I do think that existing shareholders should subscribe to the rights issue. According to current prices, the theoretical ex-rights price is around 63 cents. So that means for those that do not subscribe, we are probably looking at a 10% drop at ex-rights date. The first day of the ex-rights trading for the rights issue will be this Friday, 25th of September. Yeah, and Regarding any updates, we haven't had any updates since our last report on 13 August.
Okay, I think the next question is for me. There's the question on what caused the jump in Hyphens Pharma share price to 62.5 cents in mid-July, and how is the target price of my target price of 43.5 cents derived? Okay, currently our target price has been, I think I changed it. It's currently at 49.5 cents. That was after their second quarter results was released. Our target price is calculated based on a discounted cash flow model. And yeah, generally what we see is that for them, it does seem like their growth outlook is still very intact. And over the next few years, we are looking at revenue growth of about average of 10% per annum, which I think is quite sustainable, especially when we see that their current plans are all going to be accretive to them in terms of earnings. And then, yeah, generally we just discounted it by, it's a discount cash flow model. So we took into account terminal growth rate of 2%, cost of equity of 7.4%, and risk-free rate of 2%. Yeah, I believe. Yeah, so risk-free rate is at, risk-free rate is 0.9%. Yep, and generally we just calculated it and it was 49.5 cents lah. Yep, for the jump in share price from, I don't know, I think previously was 40 cents to 60 cents. I think during that period of time, a lot of the healthcare stocks were gaining some traction, especially when people found out how the PPEs, I think it caught on with the PPEs as well, the rest of the PPEs, that people thought that, the pharmaceutical industry will get an extraordinary growth. But generally for Hyphens Pharma, they are not, because they own a lot of products, and they are not particularly impacted by one or COVID-19 situation. So what happens is that you will see a very stable growth instead of like a sharp kind of growth because of the kind of products they have in their portfolio. Yeah, so I hope that answers your questions, and that's it from my side.
Natalie, you want to take the S-REITs on the elections? I'm not sure you want to. Okay, anyway, the question, let me just read it out. How will SG REITs and stocks be affected in the final event of a Biden win in the coming US election? I think the general view is that it will be a positive if Biden wins. I mean, the main thing is that you will basically avoid any risk of further escalation in this tariff, in this trade war. And secondly, the foreign policy towards not just Asia, I think the whole world, including Europe, will not be so aggressive and volatile, unlike the current regime, I guess. I think if Trump were to remain, I think the trade war won't be just to China. I think he might even escalate it with Europe. So obviously this is not going to be good for Asia, especially Singapore, since we are so reliant on trade. These are just the general comments, and I guess it should also be positive for the Singapore REITs in general. I'm not sure how the election is going to affect the interest rates. Of course, the other thing will be just on some of those US REITs that are listed here. I think most of them are placated from any increase in corporate tax because of the structure.
Okay, I think I'll take the next. I think there's two questions on the local banks. I'll just answer that first. I think that we don't have some time to prepare his TA also. First is whether I can comment on OCBC and UOB. Okay, so generally for the bank counters, they are all facing the same issues, right? Their operating environment is the same. Generally, they're just faced with very low interest rates currently, which hurts their their net interest income. Sorry. And so what we saw was that for OCBC, I think generally in terms of attractiveness, it is very attractive now because of one thing, which is their scrip dividend scheme, which they need to pay out at least for one more half. So for February, probably for February next year when they distribute dividends for second half of this year. Generally because the fact that they can allow you to opt in at a 10% discount, it's just quite quite worth it to hold on to their shares right now. That's the attractiveness for OCBC. And for UOB, I think generally they were more impacted in the second quarter when their non-interest income was hit by a larger extent as compared to DBS and OCBC. So I think the most important thing to look out for UOB is how's the recovery like, as because right now we know that in the third quarter, as all the lifting of the lockdowns and everything, we are expected to see non-interest income recover from all three banks. But we want, if you are looking at UOB, you might want to be a bit more wary and see how fast it recovers, because the fact that it dropped more than the rest during the second quarter, you're hoping that it will recover faster during the third quarter, and that will be the key for investing into UOB. Then there's the second question. For OCBC valuation, the risk-free rate I used was 2.6%, but for Hyphens Pharma, I used 0.9%. So I can clarify that. Generally for the banks, because they issue their own bonds as well, so it is easy to peg a risk-free rate that is similar to their coupon rate, their tenor coupon rate. Whereas if you look at Hyphens Pharma, because they don't have this kind of bonds, so generally the risk-free rate for them, I peg it to the SGS 10-year bond, which is much lower. Yeah, it's last time it was at 0.9%. Yeah, and I think that's it for the banks for me.
Hi, okay, maybe I'll just jump in here for an IREIT question that just came in. So the question is asking about the yield for IREIT at current prices post rights exercise. So according to my forecast, I'll be expecting a yield of about 7% and 6.5% for this year and next year.
Hi.
You go ahead, Natalie. Sorry.
Okay, hi. So I think someone else is asking about the CCT and CMT proposed merger, and if there are any negative aspects of the merger. So I think one of the negative aspects is that obviously when these two pure plays merge, we are losing Singapore office pure play as well as a Singapore retail pure play. So I think in terms of investors that would like to diversify on their own, they are unable to, because we will lose out on these two very veteran pure plays. So that is one of the negatives of this merger. I think overall the deal has more positives than negatives. So of course, sure you lose out on the pure play, but then you will then see CICT, which is the combined entity, will trade more like Mapletree Commercial Trust, or in fact perhaps even better than Mapletree Commercial Trust. Just looking at their portfolio. So of course, CCT actually brings in grade A CBD kind of office assets, and these office assets are generally more resilient, especially in this COVID environment. It is not the office sector is more or less, or rather office using tenants are more or less more sheltered, because most of the job losses or unemployment actually comes from other sectors, and then the office users are generally more resilient. And of course, for the retail side, MCT only has one mall, which is VivoCity, whereas CMT actually brings along 15 malls. And these 15 malls, along with their own digitalization efforts, will actually strengthen CMT's positioning in the retail space. Yeah, and of course, when the merger happens, there will be cross-selling between these two platforms and the integration between the digitalization efforts. So overall, I view that this merger will definitely help to unlock some synergies, and this will drive the share price. Yeah. So in terms of negative, I hope I covered that. Just basically losing out on the pure plays in the Singapore market. Another question here with regard to the acquisition, comparing FCT's acquisition of the remaining stake in Asia Retail Fund versus the CMT CCT merger, which will be a better buy. I would say that both of these transactions are actually in their own right. They're different, and previously mentioned that the acquisition by FCT is also viewed very positively. First of all, of course, it helps to increase their suburban footprint, as well as there are some tax savings that will be unlocked from onboarding or rather gaining a 100% control of the ARF assets. So there'll be some tax savings, tax transparency savings. And then with regard to CMT, I guess CMT's acquisition, that one is more of a qualitative nature. It's a bit, depending on your assumptions, is a bit more difficult to quantify it. And that's it. We haven't actually quantified our earnings. I mean, or rather the accretion, but based on pro forma wise, the accretion will be about 4% for CMT and 7% for CCT unit holders. Yeah. So I think both transactions, we have coverage on both FCT as well as CMT, and they are both accumulates and buys respectively. So I would say that they are different, and both will will unlock additional DPU accretion for the unit holders. Yeah. So unfortunately, I don't really have a pick here for you. Yeah. Just that FCT as a suburban portfolio, this will definitely offer more resilient and protected income, whereas CMT, CCT will be more of trying to drive synergies and more qualitative in nature.
Okay, we got some questions of a view on Top Glove. I guess we don't cover it, but just to share some of our views. They released their fourth quarter results. So the profit is 1.2 billion. Is 18 times higher year on year. Quarter on quarter is 4 times higher. And then they increased dividend. Okay, that's number one. Then number two, they increased dividends 5 times. Then they did 100 million share buyback on just one day. And the share price still didn't move. So the issue is that the price action is just, there's just such a huge uncertainty that the big overhang is people are just not clear what is the real normalized earnings. And I don't think that overhang will be removed soon. I think operationally, even Outlook, they're telling you that the demand is still robust and so on. But I think there's still just this big overhang for all these glove makers in terms of what is the normalized earnings. So I think that's the only thing I can share. I mean, without stating the obvious. So even good numbers don't move it. I think these stocks might actually just move sideways until people get some comfort that even though there's when we do so-called get a vaccine, that the earnings will still remain quite vibrant. So that is the big overhang, and this overhang may not be removed in the near term. That's my worry. The next question, can you show the slide on Straits Trading again? What's the target price? Again, this is not our target price. Just to clarify, we don't cover the stock, but just to help everyone out in terms of what is the book value and where the book value comes from. So just a refresh, if you look at the NAV per share, the 356. So this is the book value, and inside this book value, again, a bit of caveat here. When we say book value is always net assets, but what they only gave us is total assets. So this is just a rough idea that most of the book, that assuming you buy into this stock, most of the book is in property and so forth. Yeah, and it's cheap, not at 3.9% yield. So that's just our comment on the stock. I'll just quickly run to, there's another question here. What is the FA, I guess, fundamental, and that's on Thai breath. Again, no change operationally. I think I need just 3 points from me. Number one, demand is coming back. As you know, they basically have a monopoly in the so-called white liquor, or basically rum, which is widely consumed by everyone, because probably the cheapest, one of the cheapest liquors around. So they got like 95-96% market share. So and the demand is coming back up. So number one. Number two, Sabeco will still be the weakness for them. I think in Vietnam the law is such that I think even you take motorbike or you cycle and there's alcohol in your system, you basically can get fined. I mean, this is what they told me. Okay, so that would be a problem. But the one that I worry of now is the protest that you see right now. Again, protest is very tricky in Thailand. You never know how it mutates or how it. When it comes to a crowd, right, and crowd becomes a mob, then you never know how this thing can be controlled. So that is a bit of a worry for me right now. That how long this protest linger and what form will it take. So long as it's this kind of peaceful protest and it doesn't, like in the couple of years ago when it went into even blocking business activity, so like stopping protests into the airport. So those are the more worrying things. But right now, obviously, it's far from it. But a bit of a worry for me in terms of the protest that's coming, because you can never really predict the outcome. For us, I mean, there's no way for us to gauge the outcome. Okay, I think the next few questions is probably a lot on TA, so I'll move it on to yeah. Okay, if you okay, the others, can you help before he does?
Yeah, sure, no problem. So I'll just carry on the Top Glove and AEM, and then after that, if there's time permits, then I'll just cover other minor stocks. So just allow me to. Okay, so let's start from Top Glove. So Top Glove, I issued a report last Monday. So it expected it did, and then on I think 1 of August, before the repricing and the so AKA stock split, or I don't really know, but it did rebound from the wave C, and then from the support, and then it went up. But if you look at my report and some replies that I'm looking at WXY, a prolonged double tree flat, corrective flat going on. So in line with what Paul mentioned, I think we are looking at more correction right now. So and do take note that the pattern, there's a broadening wedge, falling wedge pattern is some of corrective continuation pattern for the bull, but but the foremost thing is pricing to correct further down to the lower bound of the wedge pattern, and then before rebound and correction before rebound can take place. And then the next thing is it actually kind of like collaborate with confluence with the WXY double tree corrective flat as well. So let's look at AEM. So for AEM, I'm still looking for downside despite price rebounded from here, from $3.40 from the support after prolonged flat what happened. And the short has already finished. So but due to lack of momentum below the 50S 50-day moving average, and then you look at Ichimoku, I think price is going to the lagging span has broken. The leading and baseline has crossed, depth cross, and then the next thing is testing the single span B. So we are looking for a further downside again. Lack of momentum, 50-day moving average Ichimoku is pointing to downside. All right, so that's for that. And then for the banks, price did have a rebound today, and I guess STI too. But now the bigger question is, are we going to see a price going to rebound back to the resistance zone over here, support term resistance zone, or are we going to see a further downside? So if we are looking at a further downside, then we are looking at support zone between $17 and $18.50, and then the lower bound which is at around $16 to $17.21. So that's for the banks. For time's sake, I will only do DBS because I think the rest of the banks, they are still doing the same thing. I mean, they have the same price structure and weight structure as well. So yeah. So let's move on to the next question. Okay, SGX. Okay, so I'll do a last one. Before I hand the time back to Paul and the rest of my colleagues. So for Wilmar, as although it has a strong rebound, price tested resistance here at 4.53. Close below the is attempting to close above the 50-day moving average despite of the golden cross over here. So I think this one is more of an exhaustion gap. So it's kind of like if this gap is filled up, I think there's a lot of selling pressure over here. So I think price is going to correct further down to $3.87. And then next one, let me see. Then SGX, SGX has a good run, but I expect some pullback today. Expected we have pullback to the support level here. So I'm looking at price to test upper bound to $9.40. And then $9.60 thereafter. You can read my report on last week. Last week I did issue a report on SGX. It's still valid for another 3 weeks. Right. So I think that's all for me. I'll pass my time back to my colleague. Paul, you have anything?
I think most of the rest of the questions are on Natalie, can you help out whichever you can?
Okay, hi. So we have a question here on Manulife US REIT. So why are we seeing a drop in Manulife US REIT while Prime's share price increases? I'm not sure if what kind of time frame you're looking at. If you're looking at today's time frame, yes, Manulife is down slightly, while Prime is about flat. If you're looking about since initiation, I think Manulife is actually up by 7.6%, while Prime is up by less, which is about, let me see, 6.4% versus Manulife's 7.6%. So I don't know what kind of time frame you're looking at, but more or less we think that both of these REITs will more or less trade in tandem, or rather together. In terms of fundamentals, the fundamentals that are underpinning these both counters is obviously the office using sector in the US, which is still resilient in comparison to the rest of the sectors. In terms of collection, I think both are relatively healthy. So that from a fundamental point of view, we think that that is relatively resilient and safe. So I don't know if you'd like to clarify what time frame you're looking at here. Okay, another question on Capital DC. Believe that capital. The question was, I believe that Phillip gave an overvalued rating on Capital DC in July. Is your rating still overvalued, or should one take profit when the REIT is strongly overpriced, or stay in for the dividends? So for Capital DC, yes, you're right. We actually have a neutral call on Capital DC. One of the reasons is because at the current valuations, KDC is currently trading almost 2 times price to NAV. So in our view, that's relatively expensive, and the dividend yields are already like compressed to about 3%. So we think that there are a lot of other counters out there that they're relatively resilient, and there's also some growth there. So in terms of whether or not you want to deploy your capital to earn a 3% return versus a 5% return, we feel that other sectors are actually looking a little bit more attractive. So in our view, Capital DC is still a neutral for this reason. I believe that Weiren actually also issued a technical analysis on Capital DC. So maybe Weiren would like to comment on that.
Sure. Thanks, Nat. So for Capital DC, I'm still holding up for the buy. So anything you wish to find out, you can refer to my report in Stocks BNP. But currently, I think last week we have like a slight correction at the resistance zone at $3. So the next resistance zone at 3.09 to $3.10 is the major one. So breaking that, we'll see price actually hit up to $3.40. Yep. So we are still looking at that, and then just stay on for now. And then for Ichimoku wise, we are still seeing on the upside. The lagging span has really crossed above the candle, so we are looking at everything is pointing up. So we are still seeing a resumption of the uptrend. All right. Then since that, I'll take this chance to answer on Escort REIT. So Escort REIT, we are seeing a rounding bottom here. Prices is still below 200-day moving average, but we are seeing resistance zone being tested. First is 0.95 to 0.975, and the next one is 1.025 to 1.055. Prices is still, if you look at the pattern, so prices has already broken out of the falling wedge. So upside, there is still an upside, but this major resistance at 1.025 is presenting a challenge for now, right? So that's all for me. Thank you.
Sorry.
Yeah.
So I would just like to add on to the Capital DC. So I think based on technicals, we were saying that he sees the price moving towards the $3.40 range. So I think what will enable the price to move to that range, of course, would be acquisitions. In terms of AEIs, Capital DC has been very active in trying to unlock value within the portfolio by trying to convert some non-DC space to DC space, etc. So most of the portfolio has already been underwent whatever AEIs that could possibly be conducted to unlock this value. So in terms of whether or not the price would be able to move to $3.40, I think that will really depend more on other inorganic kind of acquisitions. Yeah. Otherwise, if everything is status quo, yeah, our fundamental view is that KDC is trending towards the expensive range. Paul, back to you.
Do you want to comment on the Parkway? I know you don't cover, but I'm not sure if you like just mention everything is triple net lease, master lease, and everything. I think.
Yeah, for Parkway, I think this it's relatively safe counter in the sense that they had very long leases, and also like Paul mentioned, it's like triple net kind of leases. So this relatively safe, and everything's more or less locked in. I think they have some expiries coming up, but then again we don't really cover, so we can't really comment much on Parkway. As to whether or not you can take profit, as to whether or not you should take profit, yeah. Yeah, I think the prices currently is actually relatively high already. It's like the all-time high. Maybe Viren can share some insight whether or not there's any noticeable trends for Parkway.
Parkway Life exponential growth. Definitely, I think based on this, I think we have a super extended wave 3. 1, 2, and then 3, and then 4. I mean, with expanded wave 5. So bearish candle. So we expect price to actually retest the horizontal support level at 3.81. All right. So because of this very longish doji-like candle, I know it don't resemble a doji, but it look like long-legged doji. I mean, it differs from the textbook style, but I will expect price to correct further since we are extended wave 5. So if you look at the you use extension level, expansion. So we are looking at almost close to 1.618, and then that's why of the extended wave. So we are looking for correction. So if we take a look at 1 week, yeah, we are definitely looking for a correction right now. All right, that's all for me on Parkway.
I just want to say that Parkway is also currently trading at almost 2 times price to NAV. Yeah, so it's also in the expensive range.
I think let's take another 3 more questions. Then we got to go because Viren has a 1 p.m. event. Yeah. Is commercial? Can you comment on is OUB commercial REIT a buy, and also CRCT? How about CRCT?
Yeah, sorry. So we don't really cover these 2 counters, CRCT as well as OUE, I guess, commercial REIT. Yeah, so we don't really have a rating for these 2.
Okay. I'll move on to the next. Will Phillip's research cover SPH? Even if we cover, we typically cannot disclose. But I guess just to change your question, under what conditions, just to help you out on the question, under what conditions will PSR cover SPH? When we initiate coverage, sometimes the tricky bit is that we cannot be too early. We need to be like just nice, like if we see things improving 3 months, 6 months, if we tell investor buy now, improvement in 1 year, nobody will bother. So sometimes it's a bit of a timing for us. So anyway, for us, if I were to cover SPH, 2 things need to happen. I think you first need to see the media business start to stabilize. We know it's a downtrend, it's quite a miserable business, but at least we need to see some stability in the media, especially the classified. Then we know that there's a lot of necessity, like a better word, necessity advertisement that will be there regardless of the decline in print ads. Then number 2, we need to at least get that student accommodation business start to recover. Obviously, right now it's hit by COVID, and then thirdly, you get some inkling that there will be some listing. As you know, they want to list their whole student dorm portfolio. So if you get all these 3 things right, then maybe that would be the best time to initiate. But I'm not saying that we will, but I mean, if I have to kind of come up with conditions to initiate. Okay, the next one, I think is Sasseur REIT still a buy, no rating for this, right? Netly. And then the next one, the last question will be, can you talk more about iREIT, please? Good to acquire. We'll just take these last 2 questions.
For Sasseur REIT, actually, yes, we have no rating for this counter, meaning that we have no coverage for this counter. We don't have a buy call or a sell call or any call on them. Yeah.
But I guess Sasseur, in a nutshell, you can just because these are not, they're not collecting rent. No? As you all know, it's just it's more like just a play on retail spend. So if you are bullish on consumer spending, then maybe there will be, because I'm not sure, again, I don't know the details of there's any income waivers and income support and so forth, but if it's just a way to buy consumption spending, and outlet malls is still the fastest growing category. I think even if you look in the US, outlet mall sales is always faster than what you see in the normal malls. So, but of course, we just some basic comments. We take the last one. I read.
Okay, so the question on IREIT, whether or not it's good to acquire, I'll just like briefly state what is IREIT about, and then like and its investment merits for you to understand more about it. So regarding IREIT's portfolio comprises of properties from two main geographies. Firstly, Germany. Germany has 5 commercial assets, and in Spain it has 4 other assets that it recently acquired. I think just this year the remaining 60% stake. Sorry. Yeah. So regarding this, right, we do like IREIT because the leases from these properties are very stable. We are expecting to deliver yields of 7% for this year and about 6.4% next year. For most of the leases, it's actually underpinned by blue chip tenants and a pretty long WALE of 4.4 years, which is actually higher than that of Singapore REITs. If you consider commercial REITs, is actually about 2 to 3 years. Also, CDL actually recently acquired as well, as in a stake in IREIT last year. So like we do feel that in the future, IREIT will be able to leverage on financial support, expertise, and acquisition deals from both PhillipCapital and CDL. Then yeah, so I think for now, right, our call on this is neutral because of the equity, because of the rights issue that is recently announced, which will be yield dilutive. Yeah, will be yield dilutive. So for now, I think we should probably like wait till there are further updates from this counter.
This one, last one. Okay, with so much uncertainty, is it better to invest in Straits Times ETF in the longer term? There is merit to it. Firstly, there's never been any certainty about anything these days. But anyway, I guess if you buy the Straits Times ETF, at least you don't have to think about what stocks to buy, and sometimes you don't even have the time to select. But my preference would be the REIT ETF. I think because the problem with when you buy into the Straits Times ETF, 40%. As you know, 40% is banks, and with interest rates remaining low, the banks earnings from at least net interest income will be slower. So basically, if you take the view that rates will remain low for at least the next 2-3 years, then the REIT ETF would, on paper, at least look like a better bet than the whole Straits Times. Because low interest rate actually hurt the Straits Times ETF through the banks indirectly. I think that's the only input I can give you. Yeah. And of course, ETFs tend to outperform active fund managers. Okay. Anyway, that would be the last question that we have. Again, thank you everybody for attending, and we really hope. Thanks for all your questions, and really hope to see you again next week same time. So thank you everyone, and take care. That will be the end of it. Thank you. Bye bye.